Good morning and welcome to Financial Accounting. This is day 2 of class for the fall 2022 semester. But day 1, we did not start any new material. We just talked about how the course is structured, how to find things in our new learning management system called Brightspace, and how the due dates make sense throughout the semester. So today we are going to start talking about chapter 1. And this is our first exposure to accounting material. So because of the late start we got today, I didn't have a chance to go through and delete the slides that I do not plan to use during class. So I'll be skipping through some slides that are not very helpful. I can't recall if I mentioned on Tuesday, but this is a brand new edition of the book. It just came out toward the end of the spring semester. Normally, there is a student resources website, and on that website, you have access to the PowerPoints. As of Tuesday, the website for this edition of the book does not yet have the PowerPoints available. The only information there is about the appendices to the book, which we are not covering. So I believe in our Brightspace class, there is a link to the student or textbook resources website, something like that. And it's linked to the 15th edition of the book, because the PowerPoints from the 15th edition are still out there, and there have been very minimal changes from the 15th to the 16th edition. So I use the PowerPoints during class to form the structure of what we're talking about. I have no intention of reading to you what's on the PowerPoints. I do not encourage you to try to write down everything that's on the PowerPoints. Although if you learn by writing, that's okay. I'm not going to tell you don't take notes, but that's not the intent. So you do have access to the 15th edition version of these PowerPoints from that free website that has the textbook resources from the 15th edition. So we start each chapter with the learning objectives. Again, I'm not going to read them all to you, but this is the way your textbook is structured around these learning objectives, and that is how we will proceed through the class as well. Most chapters we will go from beginning to end in the chapter. There are a couple of chapters that I just prefer ordering things a little bit differently, but it's a good way for you to connect what we're doing in class with what you're reading in the textbook. I did start in Brightspace putting in the due dates to go along with the grade book items, but for some reason they aren't showing up in the things for you to do. So I don't know if this is a Brightspace glitch or if it's just something I need to figure out how to make them show up for you there. But they are, all of the due dates, remember, are on the last page of the syllabus. All of the due dates are in Cengage See Now for you as well. Each class, I will mention what's due so that you're keeping that big picture in mind where we're going. And also, as you saw on Tuesday, I don't think I had mentioned it during class, but on Tuesday, you should have seen the announcement come out from me through Brightspace. And that announcement will come out after every class day saying, here's what we did in class. Here are the exercises. Since I am recording, I will remind you that the recording is there, and I will put the link into Brightspace for you in the appropriate chapter folder in the reference materials. So, and then I will list, here are the upcoming due dates, and I'll just give you the due dates for the next couple days, next couple class days, just so that you're keeping that in mind, because, you have maybe 3 or 4 or 5 other classes, and everyone has their own separate way of doing things and their own due dates and deadlines. So I just want you to keep that in mind. I just think it's good to have that reminder. So before we start talking about accounting, is there anyone who wants to tell me yes, I've taken accounting class before. Maybe you took one at a different school. Maybe you've taken one in high school. One person, couple people. Okay, so people who've had accounting class already. And how about anyone work or have job experience in an accounting department, billing or anything like that? So there is no expectation that you've had any accounting background before you take this class. So we will start from the very basic. For those of you who have had some accounting background, either in the workplace or in another classroom, you'll have some of the foundation, the terminology at least, which will give you a little bit of a leg up as far as that's concerned. But I do not expect that you know anything about business or accounting when you start this class. So in case you're concerned about that. As we said on Tuesday, though, we do have a great deal of work to cover in this semester. And so, although I don't expect that you already know anything about what we're talking about, I do move fairly quickly during class. Certainly what you're reading in the textbook will supplement what we talk about in class. And I already mentioned that on Tuesday, how helpful it is for you to have read the chapter before we talk about it in class, or at least have skimmed it and looked at the key terms and the key concepts throughout the chapter. So our focus for this semester is going to be on publicly traded companies in the United States. On Tuesday, we talked about one of the first tasks you have for class is to choose a company for that real world annual report project that you'll be working on in pieces, chapter by chapter throughout the semester. So our focus is on publicly traded companies, and publicly traded companies follow one set of rules or principles that guide how they prepare their financial reports. And our job throughout this semester is to learn what goes into those financial reports, how do you do the accounting piece, and how do you interpret or use that information to help businesses make decisions. So we need to know what a business is. And I'm never, ever going to ask you for a textbook definition, but for our purposes, a business is any entity that is engaging in financial transactions, maybe with a customer. So they have customers, they have suppliers, they might be producing a product, or they might just be buying a product from a supplier and reselling it to a customer. So they're part of that supply chain. Again, for our purposes, we need to keep the business separate from the owners, from the customers, from the employees. That concept is known as separate entity. And it's a very important concept in accounting. It is different than the legal standard of a separate entity. So in the United States, there are three main forms of business organization, or three traditional forms of business organization. The most common, that is, there are the most of this type, is a sole proprietorship, a small business where the owner is also the manager of the company. So a mom and pop kind of store. Roughly 80% of businesses in the United States are a sole proprietorship like that. But about 80% of the production of businesses, 80% of the GDP, or gross domestic product, if you know that term from economics, about 80% of the production of our economy is from corporations. So lots more sole proprietorships, but they tend to be much smaller in general. Many fewer, only about 20% of the businesses are corporations, but they produce about 80% of the GDP produced by businesses in this country. Again, our focus will be on those corporations, specifically ones that are publicly traded. And the reason for that is, one, because those are the companies who are required to share their financial information with the public. And So we have access to it. So the company that you choose for your annual report project for this semester needs to be publicly traded so that you make sure you can get that information from, the internet, from the company. They're required, if you are publicly traded, you are required on an annual basis to prepare a set of financial statements along with their accompanying notes, which are really the explanation or the detail of what's in those financial statements. And they have to have that audited by an external auditing firm, a CPA firm. And then they have to make those statements available to the public. So even 20 or 30 years ago, the way those statements were made public was they mailed them out to all of their shareholders. They printed them, a bound copy of the annual report, and they mailed them. Today, much more frequently, if you want information about a company, you go to their website, right? So, and that's how I would expect that you get the information you need for your project for this semester. You're looking at the company's website. They're required to provide that information to you or anyone who asks, anyone looking for it, because they are publicly traded. Private companies don't have those same requirements. And so you can't choose a privately held company for your project because you wouldn't have access to their financial information, for one. And two, if they're not publicly traded, they probably follow some version of the accounting principles that we are learning this semester, but they don't have the same specific requirements for disclosures or reporting that a public company does. I mentioned there were 3 different traditional forms of business organization, and I talked about sole proprietorship and sole proprietorship and corporations. I left out the one that makes up about 8% of businesses, and that's a partnership. So a partnership is similar to a sole proprietorship, but there's more than one owner. As I said on Tuesday, please just stop me if you do have questions. If there's anything that you think that I glossed over something, you didn't understand something I said, you do not need to wait for me to ask, do you have any questions? It's particularly difficult in this classroom because I'm behind all of you. And so even though I keep turning and looking, most people are not looking at me. That's fine, but I can't see your face to see if you're giving the screen a look like, what did she just say? What does that mean? So a little bit more of the burden is going to be on you to tell me if you need more explanation, if you didn't understand something I said, if you have a question, you need to tell me because I can't see your faces to know if you're looking quizzical. There are also, in addition to the 3 traditional ways that businesses are organized, sole proprietorship, partnership, corporation, there are 3 different types of businesses, meaning the way they do business. What types of products or services are they selling? And so you can see those on the screen right now, the 3 different types of business. Service businesses aren't selling a product at all. So a hair salon is mostly a service organization. That doesn't mean they don't sell any products. So they might have a little bit of retail thrown in there. Many hair salons also sell styling products, shampoo and things like that. So that piece would be retail, but the prime focus of the business would be service. A law firm, a CPA firm where you take your accounting or your payroll, those are all service businesses. Businesses that do landscaping and lawn mowing and snow plowing, those are all service businesses. A retail business is really where our focus is going to be this semester. And rather than calling them retail, I really prefer the term merchandising business because retail implies you're selling to the end user. So a grocery store is a retail operation. But there are wholesale grocery companies that act as a middleman between the supplier, the people actually making the food, and the grocery store. And that is also a merchandising business. They're not making the food, they buy it from someone else and they sell it to someone else further down the supply chain. So retail businesses, I think, is a little bit limiting because it implies selling to the end user. But so I will more frequently use the term merchandising businesses. And that again is really our focus for this semester. If you look ahead to chapter 5, the title of the chapter is something like accounting for merchandising or accounting for retail operations. So retail businesses don't make the products that they sell. Again, there might be a little bit of crossover. So if you go into Wegmans, they have a bakery and they have, you know, a deli counter where they do actually make some food, but primarily they are selling food that was made by some other business upstream in the supply chain. Manufacturing businesses then are really the most complex of these three, because not only do they sell a product, making them more complex than a service organization, they make the product they sell. And so knowing how much that product costs them to produce is more challenging than for a retail business that buys the product from some other wholesaler and they have an invoice that shows, here's the price of that product. A manufacturing company does not have that option. They make the product themselves. So I assume, I don't want to jump to too many conclusions, but I'm assuming that most everybody in here is a business major of some kind. Is that right? Is there anyone who's not a business major? Or thinking of being a business major? Okay, I don't see anyone saying, yeah, that's me. So if you are a business major, if you want a business degree from JCC or probably any other school, certainly any other school in the SUNY system, you need to take the 2 semesters of accounting. And so this first semester, financial accounting, we're focused on retail businesses. We are focused on preparing financial statements. And in the second semester, Business 1520, which is principles of managerial accounting, our focus shifts to internal reporting and manufacturing businesses. So we're looking at more of the cost accounting part of, you know, how much did this product cost us to make. Okay, I mentioned there's going to be a couple slides that I skip over. Normally at the beginning, before class starts, I would just delete those, and I didn't have a chance to do that today. So don't worry about what's on those slides. You know, there's some people who are like, wait a minute, what was on there though? Wasn't that important? No, it wasn't important. It's skipped an icebreaker. They'll have examples. We're going to be doing our own examples in class. And so you will not need me to show you, or we're not going to walk through examples in the PowerPoint, because we have our own examples in the exercises. With that being said, I'm going to show you, oops, I need to get to my Cengage. So I had talked to you before I started recording, before class started, about having your chapter 1 exercises open. Okay, so if you have them open, let's take a look at those. I know I showed you what these look like. I'm going to make that a little bigger since that. Okay, so this is exercise 1. In this first chapter, there are a few exercises that I'm going to be asking you to complete outside of class on your own. I would ask you, please don't do them right now, because that means you're paying attention to what's on your screen rather than we're just going to be continuing with class. So this is exercise 1 in the chapter, and this is one that I'm going to ask you to complete independently. I already talked to you on Tuesday about the goal is not to make the red X's go away and get all green check marks. The goal is to learn something about what the point of this exercise is. So please keep that in mind and give it your best effort before you use that check my work button. We already talked about service, retail, and manufacturing. That's the point of this exercise, is to make sure you understand what that is. Now, I also realize that there may possibly be some companies on this list that aren't familiar to you. And so you might not know what they do. That would be one reason that it's legitimate to guess and check. right? So you don't have to look up. If you don't know what SunTrust is, and honestly, I don't know what SunTrust is. So you don't know what SunTrust is, you don't have to go look them up to answer the question. You have my permission to just guess. I think it might be a financial company, and so it's probably a service organization. Sounds like a financial company or a real estate company or something like that. So I'm going to ask you to complete this exercise on your own for each one of those companies. Indicate which type of organization it is, and then answer the last question there in part B. We haven't even talked about the accounting equation yet, so we'll get there though. Usually we'd get there today. We got a bit of a late start. We'll see if we get there. Okay, one other comment before we move on from this exercise. So after each company name, there is a letter or 2 or 3 or 4. There aren't any 4 letters there. In parentheses, does anyone remember? I told you on Tuesday what that is. What's that called? So Caterpillar says cat after it.
I remember that's the stock. The stock abbreviation.
Yeah, it's the abbreviation for the stock. Good. So that's close enough. It is the trading. It's called their trading symbol. So it is the abbreviation of their stock on the exchange where they're traded. Good. Okay, so that's exercise 1. You're going to complete that on your own. I'm going to keep going. There are a couple more in this chapter I'm going to ask you to complete on your own. You just have to find where they are. Exercise 7 is the next one. And so we'll be talking about the concept in exercise 7, but you might want to just make a note. We're not going to do that exercise together in class. And there's one more, exercise 9. God bless you. So exercise 9 is another one where you're going to be choosing, you have a 50-50 chance of getting it right. We are going to be talking about the concept in class, but not doing that exercise together. So if you want to make a note, exercise 1, 7, and 9 in this chapter, you will complete independently. Questions, anybody, before we keep going? As I said, please do not work on those exercises right now, because we're going to keep moving in class. Yes, sir. Yes, you hit submit for grading. Yeah, so give me 1 second. So after a brief pause, we are back. And we're going to keep moving on with the chapter 1 information. So when we think about a business, I already explained to you the 3 different types of business organization. We're going to be focused on corporations and about the 3 different ways of doing business. And we are going to be focused on retail and merchandising operations, companies that are buying product from a supplier and selling it to a customer. We also talked about separate entity, so that we know we're only accounting for the activities that happen within a specific business. So we're not recording transactions for the customers, for the employees, for the owners of the company. It's only the activities that affect the company itself. So on this exhibit, you can see 3 different types of activities, and every business activity we can classify as one of these 3. The main activity is the one in the purple box down here at the bottom. It says operating activities. So those are the activities that the company engages in on a daily basis. Buying product from their suppliers, paying their suppliers, selling product to their customers, billing and collecting from their customers, employing people and paying their employees, paying their taxes, paying the energy bills, the electric bill, the gas bill, or whatever. All of those are the day-to-day activities that a company does in the normal course of operations, hence the term operating activities. The other two then that you see there, investing activities on the right and financing activities on the left, are less frequently occurring. Investing activities include buying and selling of plant assets, fixed assets like equipment, buildings, vehicles, the long-term stuff that they use to run their business. It also means financial investments. So it might be buying and selling stock in another company, buying and selling bonds from another company, buying and selling government issued bonds, things like that. So those happen on a less frequent basis. And then the third one, the one on the left, the financing activities in the red box. Financing activities are, where do we get the money to do all that stuff? So it includes buying and selling their own stock. So if you look ahead on the syllabus, chapter 12 is focused on stockholders' equity. And that refers to the ownership stake of the stockholders or the owners of the company. That's what makes public companies unique, is that they have external stockholders. So if you think about buying stock in, Tesla, or buying stock in, whatever, Disney, or whatever other company you might be interested as an investment, that stockholder piece is part of the financing activities. Selling stock is one of the advantages of being a corporation, that you have what's called ease of capital generation. I'm going to put that on the screen. This is what I was talking about before class. I normally would write this, on the board, but it's not convenient that the board is at the front. That the board is at the front of the classroom and the computer's back here. So ease of capital generation means that we can go to the public to raise financial capital, to get money to run our business. We can do that in two different ways as a publicly traded company. We can sell our own stock, and we can issue debt. We can issue corporate bonds. So corporate bonds is the focus of chapter 11, and the stock piece is the focus of chapter 12. So we'll be getting to those probably in April, toward the end of the semester. Other financing activities, so selling our own stock, selling bonds, paying back those bonds, paying dividends to our stockholders, buying back our own stock. Again, we'll talk about that in a couple months in chapter 12. So again, one of the advantages of the corporate form of organization is that ease of capital generation, that we can go to the public to raise money. If you want to start a business, maybe you are really good at making cakes, decorating cakes, and you want to start a business, where are you going to go to get that money? Maybe you have friends or family or an angel investor who will come in. Maybe you can go to the bank. If you have a really solid business plan, you can go to a bank and borrow money, but you can't just sell stock on the same publicly traded exchanges such as the New York Stock Exchange or the NASDAQ. Larger publicly traded companies have access to those capital markets. Okay. So I started out class talking about how if you want to earn a business degree from JCC, or probably literally any other school you can think of, you're going to have at least 2 semesters of accounting. And that means everyone, even if you are planning to transfer and seek a higher degree in marketing or management, human resource management, we still make you take accounting. Now, if you're in the transfer-oriented program, the Associate of Science or AS degree here at JCC, there are only 2 business courses that we tell you, you must take these courses. So why is it? What is so important about accounting that makes them a required part of every single business curriculum? Anyone want to take a stab at that? Why do we make you take accounting?
It's like the start of the like,
Okay.
it's like one of the most important parts.
Yeah, and so from my perspective as an accountant, it's the most important part, but yeah, it's definitely one of the most important parts. I'm just trying to get people's names, so if you volunteer an answer, I'm probably going to ask you to tell me your name, because that will help me to remember. As I said, on Tuesday, it's going to be particularly difficult because I'm not even seeing your faces sitting back here for the most part. So that's not as helpful. So the reason we make you take accounting is because every single organization out there has accounting. And it does not matter what you do with your life, unless you go live in the woods, you're probably going to encounter accounting of some kind. Even if you go into human service, that agency has a budget. And if you're a supervisor, you're going to be held responsible for that budget. That's part of accounting. Budgeting is a whole chapter in our textbook that we cover in managerial accounting. So you can't avoid accounting. It's not just because people like me like to talk about accounting for what seems like hours on end. It's because it's a critical piece. As Lucas said, it's a critical piece of that business, of every single business. Even if you're a not-for-profit organization, you still have accounting. So what does accounting do? Again, you can see it up on the screen, but as I said, I don't plan to read you what's on the screen. You are welcome to read it yourself, but I will just be giving you kind of a nutshell of what's there. So in my words, the purpose of accounting is to help decision makers make decisions about that company. It's to help decision makers make decisions. That's the whole point. We're trying to provide useful information in a clear and concise format so that people can look at that information and make a decision. I know this is small up on the screen, especially if you're sitting toward the back of the classroom. All of the exhibits that are in the PowerPoint are also in your textbook if you want to be able to look at a bigger version of that. But the accounting is a system. We put information in, we gather information, we put that information into the system, we, in the jargon, crunch the numbers, and we spit out reports. In this class, you're learning to make a very specific set of reports that are required for publicly traded companies. In managerial accounting, we shift that focus and we're talking about a little bit more flexibility. So financial accounting is geared toward external users. And we are preparing what are known as, up on the screen, general purpose financial statements. General purpose financial statements. These are designed for all users. So we don't know exactly who might be looking at those financial statements. And so we want to give the information in a common format so that anyone looking at them who knows something about accounting will be able to make sense of them to help them make their decisions. Excuse me. The that class is now open.
Oh, okay, thank you.
Yeah, you're welcome. So you're probably the one person I didn't have on my list. Oh, he. Okay, so this young man was probably the one person I didn't, the one who left from here. So we have a set of financial statements that we are learning to prepare that should be able to help anyone who's trying to make a decision about our company. It's geared toward external users, people outside the company. So who do you think might be trying to make a decision? What kind of decisions might people be trying to make about our company? Who might need to know something about the company? Why is it that publicly traded companies are required to make their accounting statements public?
Investor.
Yeah, sure, an investor or a potential investor. They're looking at company A and company B saying, I've got some money to invest. Which one should I buy? So they're weighing things like, which one is more profitable, but which one's more risky, right? Okay, perfect example, someone outside the company. Now, those people, investors, have a direct financial interest because they're considering owning a piece of that company. So external users with a direct financial interest is one category. Who else might be trying to make decisions? Yeah, that's what he said, yeah. Who else? When you guys are looking for a job, you graduate from JCC and you're looking for a job, or you transfer and you graduate and then you're looking for a job. Might you want to know something about a company that is offering you a job? I would. I'd want to know, I don't know, am I going to have this job next year? I've got 2 different job offers, and which one looks like a more stable company, right? Which one looks like they have more growth possibilities for me? Okay. So employees or potential employees are definitely interested in the financial health and well-being of that company. How about any government agencies might be interested? Which type of, for what purpose? Who might, at the government level, who might want to know about our company? The IRS, yeah. So any taxing authority is going to want to know. Now, I do need to point out that what we are covering in this class is financial accounting. Tax accounting is in some cases very different. You'll hear me say a few times during the semester, okay, tax looks like this, but financial accounting looks like that. There are definitely, every company has at least 2 sets of books. There's nothing shady about that because some of the tax rules are different than what we're learning in here. But absolutely, if we look at accounting in general, a taxing authority such as the IRS or the New York State Department of the Treasury or whatever they're called, are definitely, I think it's New York State Department of Taxation. They definitely are interested because they want to make sure we're paying the taxes that we owe. Who else? What about a labor union? If your company is unionized, do you think the union's interested in your financial statements? Yeah, why? They want to know, how stable are you? Should we be asking for 7% raises for next year, or should we just be hoping to avoid a layoff for our workers, right? They want to know how well you're doing. A union is an example of an organization with an indirect financial interest because they don't own stock in the company. They don't work for the company, but they represent employees of the company. So they're indirectly interested. Maybe a consumer watchdog organization, trying to make sure that companies aren't doing something they shouldn't be doing and being unfair to a consumer, something like that. So lots of different groups outside the company who are interested in the accounting information. What about inside the company? So there are definitely internal users. They're much less likely to use the financial statements that we are learning this semester, but they are the only users of the reporting that we talk about in managerial accounting, because that's definitely geared toward internal users. So who inside a company might need to know something about the company's accounting situation, accounting information? I'm sorry, managers. People are trying to make decisions about, should we be hiring people? Should we be putting on overtime? Should we be making more of product A and less of product B? Should we be looking to close down this location or build a new factory? All those kinds of information are at least going to be helped by knowing something about the accounting information. So managers of the company are internal users, and they need that information to be able to make decisions about how best to run the company. Make sense? So we've got the 2 big pools of users: internal, which is the focus of managerial accounting in our second semester, And then financial or external users, excuse me, who are the focus of what we're learning this semester. And within those external users, we have both indirect and direct impact. I'm not going to spend a lot of time right now talking about ethics. I do not want it to sound like, well, we talk about ethics in chapter 1 and then we don't have to think about that anymore. The concept of ethics in accounting is going to flow through the entire semester. In pretty much every chapter, I will point out, here's an issue where ethics might be, a question. Here are the kinds of decisions as accountants we need to make. Here's the two sides of a topic that we're having to weigh, which one's more important than the other when we have to make a choice. But ethics clearly is a big component of what we do in accounting. Most of you probably weren't even alive when in 2001, maybe, when there was an act of Congress called Sarbanes-Oxley, or SOX, or Sarbox, if you want to sound cool. You'll notice in a lot of what we talk about, we use a lot of acronyms. Everyone know what an acronym is? Put that word on the screen here. An acronym is generally, you have a phrase and you take the first letter of each word and use that like the, in place of or as a shortened version. So SOX, what's that? Like NASDAQ, exactly, like NASDAQ is an acronym, the first letter of each of the 6 words in that system. And so we use a lot of acronyms in accounting. I tend to think we do that because it kind of keeps accounting as a little club. I don't know, there's not a lot of people who think, oh, accounting, that's cool. And so we think, if we can make it a little more exclusive. I don't know, that's the only thing I've come up with. I think probably every pastime, every occupation has its own language. And it depends on who you are and what you do as to whether you know that internal language. So you'll hear a lot of that throughout this semester. I'll give you an example. If I say the word pool, what do you think of? What's a pool? What's that? What'd you say? Water. So it's summer, still summer. And many of you may have, been swimming in a pool this summer. But if you are into bedding, you might think of a pool as being a bedding tool.
To be warm.
Yeah, so there's that. If you like billiards, when I say pool, you're thinking of 8-ball, right? The green felt covered table and you have a cue stick. And so it totally depends where you're coming from, what those terms might mean to you. And it is exactly the same way in accounting. So that's one reason I have asked that you read the chapter or at least skim through it and read the highlighted words, read the definitions that are in the margins, so that you've at least heard those terms before we use them in class, because you will be much further ahead if you do that. As I said, ethics is something that we're going to talk about consistently throughout the semester. In 2001, there was an act of Congress called Sarbanes-Oxley, or SOX, that was aimed directly at this concept of ethics, because leading up to that, there had been some major accounting scandals that kind of rocked the business world, including Enron, WorldCom, HealthSouth, Adelphia Communications, if you live in this area, might be one that's familiar to you. And so with those accounting scandals, it became necessary to somewhat reestablish the credibility of accountants. So I already talked to you earlier in class today about how when you want information about a publicly traded company, you're probably going to go onto their website and access their financial statements that they have to make publicly available. That's the only access we have as potential employees, as potential stockholders or investors. That's the access we have to information about the company. And so we really need to be able to trust that that information is credible, reliable, that it's going to lead us to an appropriate or correct decision about that company. We need to be able to trust the accountants who put that information out there. And that trust really was eroded throughout the 1990s, leading to the passage of that Sarbanes-Oxley or SOX. It is, in case you're wondering, Sarbanes and Oxley were a congressman and a senator who were the main sponsors of that legislation. And so that's maybe what they're most famous for from their time in US government. So I mentioned Enron. There's a couple more. You can read about these in your textbook. We're not going through all of those. But the issue, again, was credibility or believability of accountants, and it's how critical that is to our system. I'm not going to focus too much on the accounting career paths. Most of you are probably not considering a career in accounting. I'd be happy to talk with any of you about this if you are interested as we go through the semester. And it's in your book. So as I already explained, this semester we're learning about a set of rules or principles that tell us what we must do to prepare those financial statements to make sure that everyone's following the same set of guidelines. You can see up there on the screen right now the name of that, and it's GAAP. Another acronym, Generally Accepted Accounting Principles, or GAAP. It is set by a group known as the FASB, Financial Accounting Standards Board, FASB, pronounced FASB. And the FASB is the group that is in charge of setting those standards. Now, this is US GAAP that we are learning. Many other countries have their own accounting standards. There is also a set of accounting standards that are called International Accounting Standards, IASB, and IAS. I do not want you to get the impression that the US is kind of it's the US versus the world and everyone else uses the IAS. They do not. Many other countries have their own standards. And we have ours. In order to be publicly traded in the United States, you have traditionally been required to follow GAAP. Now there has been a convergence project ongoing for, 20 years between the International Accounting Standards Board and the FASB in the United States, trying to iron out some of the differences, the big differences between the standards. And so it is possible today that a company could follow IASB or IAS, and still be publicly traded in the United States with some additional requirements. So, excuse me. What you are learning in this class is US GAAP, and it's what publicly traded companies in the United States are required to follow. Excuse me. The SEC, I'm just picking out a couple things here to talk about as we go through. You'll read about this in your book as well. The SEC, Securities and Exchange Commission, is a quasi-governmental organization that has responsibility for publicly traded companies to protect the investing public. The Sarbanes-Oxley Act created another group known as the PCAOB. Might be on the next slide. No, let me put that up there. The PCAOB, Public Company Accounting Oversight Board, which sounds like it might have some overlap. Oops. OB, Public Company Accounting Oversight Board. came out of Sarbanes, it was established through Sarbanes-Oxley, and after some legal challenges, it was pared down, and it still exists in a little bit pared down form from what was in the original legislation. They are similar, kind of, to the SEC in that their job is to make sure that the information coming out of publicly traded companies and being shared publicly is reliable. I'm not going to read you all the terms on this slide, but you definitely should be reading about them in your textbook. And if you don't understand what any of them means, you should ask. I'll be happy to talk about them, but I definitely do not want to be sharing, taking class time to talk about terminology like this. As I told you on Tuesday, I really prefer we spend most of our time in class doing accounting, working on exercises. Chapter 1 is a little bit different because we have to get this terminology stuff, kind of the foundation out of the way before we really start doing accounting. Excuse me. Every publicly traded company is required to file an annual report that they've had audited. I already mentioned that. But every company does not use the calendar year, that is January 1st to December 31st, as their reporting period. Companies are free to choose the end of their accounting year or fiscal year, their reporting year, to be whatever day they wish. And so most companies will choose, if they have a cycle, so if they have a busy season and a slow season, most companies will choose to have their year end during their slow season. So that's called their fiscal year, the 12-month period that they're doing their reporting. Some companies, even like Motorola, their fiscal year ends on the last Friday in January. So it's not even the same date every year. And every so many years, they might have 53 weeks in their reporting rather than just 52. So, but that's what works for them, and that's perfectly acceptable as long as they do the same thing every year. Talked about those already. Okay. So what we are going to be doing in accounting is recording transactions. When something happens that affects the financial position of our company, we need to report it. We need to record that in our accounting records. Now, not everything that happens that's significant for a company is actually a transaction. So when you read about something that happened in the company, the first question you're going to ask is, I don't know, is this a transaction? Is it something that affected the financial position of our company? We'll get into that a little bit later. I want to make sure we get to this before we run out of time. And what time does this class end? What time? Oh, good. Yay. Awesome. Yeah, we have more time than I thought. Fantastic. So the terminology that I just skipped through, we will get to that. Can't avoid it. So don't be worried about what did she just leave out. We'll get to it. But I wanted to be able to maybe stop talking for 4 seconds and look at actual doing of accounting. So what you see up on the screen right now is the accounting equation, or the fundamental accounting equation. So what does it mean if something's fundamental? Yeah, it's like the foundation, right? You build everything on that, and that is true of this equation. So I think it's important to keep in mind that this is the fundamental accounting equation in its simplest form. Assets equals liabilities plus equity. Assets are something that the company owns or controls that will help them or benefit them in the running of their company in the future. So assets include things like cash, equipment, inventory that they have available for sale to their customers, buildings, supplies that they have for the running of their business, vehicles, anything like that. The company owns it, and it's is using it or will be using it to run its business. You'll notice it's an equation. So we have the, oops, sorry. We have this equal sign here, right? We have this equal sign right there in the middle. It's an equation. The two sides must always be the same or in balance. In balance. In accounting, because we're working in the United States, we're going to denominate everything in dollars, in US dollars. And so the dollars on the asset side must always be equal to the dollars on the liabilities and equity side. So we know what an asset is something the company has that it's going to use to help it in the future to make money. Liabilities, does anyone know what that term liability means? Just in a general sense?
A risk causer or risk hazard?
Yeah, outside of accounting maybe, but yeah. What did you say, Patty? A creditor. Okay, so that term is associated with it. So a creditor is someone you owe something to, that person or that entity. A liability is the amount that you owe. Is that okay? So if you have you ordered some supplies from WB Mason and they delivered them to you and you just haven't paid the bill yet, that's a liability. You owe WB Mason for all of that copy paper you bought. If you owe taxes that the bill's not due till next month, but you owe it, that's a liability. You bought stuff from suppliers, you bought some inventory, you haven't paid for it yet, that's a liability. You borrowed money from a bank to build a new building, or you borrowed money from the public through issuing bonds that I mentioned earlier, that's a liability. Okay, so a liability is something that you owe to someone outside the company. Equity is what's left. It's known as the residual. So equity is the residual. It's what's left. So if we take our assets and subtract our liabilities, equity is what's left. If you've ever heard of a home equity loan, it's exactly the same concept. The home represents the asset. I'm just going to put numbers on this so you can see what I'm talking about. So let's say you have a home, and the home, just for the sake, whoops, got to put your fingers on the right keys. Just for the sake of argument, let's say the home is worth $100,000, okay? And you maybe put a down payment on the home and you've been making mortgage payments for a little while. And so maybe you still owe, just throwing numbers out there, $75,000. So how much equity do you have in that home? It's worth $100,000, but you still owe $75,000 on the mortgage. How much equity do you have? $25,000. That is exactly what we are doing with the accounting equation. Okay. Only we're going to have more than just one asset and more than just one liability, but it's exactly the same concept. The asset total has to be equal at all times to the liability and equity total. The equity is what you own free and clear that you don't owe to someone else. Now, there's one little caveat I need to throw out here, and this is one of the terms that I skipped on the earlier slide. In accounting, we're going to use what's known as the historical cost principle. And so that house that I said was worth $100,000, what that means is it was worth $100,000 when we bought it, using that historical cost principle. So we're not looking at, well, how much could we get for it if we sold it today? If you know anything about real estate right now, prices are much higher than they have been. And so it might be that home is worth $200,000 now. I don't know, 150, something other than 100. But on our accounting records, it's still going to show that it's worth 100,000 because that's how much it was worth when we bought it. Now, if we sell it for 150, we get to record that we received the cash for 150, and then we pay off that mortgage and we'd have 75,000 left. But on our accounting records, we must record it at what it was worth or what we paid for it at the time we acquired it. Everybody good so far? So this again is the fundamental accounting equation, and we will be expanding on that as we move ahead. But so that I can stop talking for 3 seconds, I would like to go to our second exercise. So if you still have your Cengage See Now exercises open, we're going to be looking at exercise 2. I didn't talk about calculators on Tuesday. You don't really need any kind of a special calculator for this class. You will want to be able to add, subtract, multiply, and divide. I encourage you not to use the calculator on your computer just because it's clunky. So, but using the calculator on your cell phone is fine. That will do pretty much everything. Even a basic cell phone calculator will do everything you need for this class. I happen to have assuming that the battery isn't dead because I haven't used it in a while. I do carry a graphing calculator, but you absolutely do not need any kind of a special calculator at all. The cell phone calculator will work just fine, and so will the calculator on your computer. I just hate to see people jumping back and forth. It just gets a little awkward. So let's start with our first letter A here. So for this particular company, we know the liabilities are $1,200,000 and the stockholders' equity is $875,000. And the missing piece is how much are their assets? Did not press refresh? I think what they're concerned about is if you refresh and it hasn't saved, like lose something. But it does save your work if you move from exercise to exercise. There's no need generally to save. So that's probably like their CYA, and I'm not gonna say don't press it, and then if they do, it's their problem. I've never had an issue of it losing something when you move around like that, so. Okay, so what, we know the liabilities and we know the equity. How much would the assets be for this company then? Anyone? $2,075,000. Okay, how did we find that? We added the liabilities and the equity together because there's that equal sign there. We know that the two sides have to be the same. Now, we'll see this frequently in our exercises. There's no situation ever where we would know the company's liabilities and equity and not know their assets. That's just not going to happen. But we frequently will, in exercises, see unrealistic scenarios like this because it's just challenging us to think about how are these pieces related to each other. Okay? But it's never going to be in the real world situation that your boss says, hey, we owe our creditors $1.2 million. And by the way, our equity is $875,000. What do you think our assets are? That's not going to happen. How about letter B? We know our assets are $3,860,000. Let me just tell you, so sometimes I think that maybe I could have been a math teacher, I'm not sure. Accounting is not math. Accounting is math like Sudoku is math. If you play Sudoku, it's not math, right? It has numbers, but it could just as easily be letters in Sudoku, really. But it happens to be numbers. Accounting is not math. We do some very basic math, adding, subtracting, multiplying, dividing, very basic. Accounting is more about what do the numbers mean? What do they tell us? Where do they go on this report? And how do we use this information? Just like Sudoku. It's not math. So we know oh, I was gonna say something about math. So when you read a number, here's my helpful hint. When you read a number, you don't use the word and in the number. So that number that I just read, $3,860,000, you'll notice I did not say and in there. The and doesn't mean a comma. You say and when you get to the decimal point. So if it was 3,860,000,000, what did I say? $3,860,000 and 14 cents. The and represents a decimal point when you're reading a number, not a comma. So it is actually not correct to say it's 3,860,000. Just a hint. Your math teachers will think, wow, she really knows about numbers if you read that correctly. So we know their assets, we know their liabilities. How much is we know their assets, we know their equity. How much is their liability total? $2,960,000. So I can't see everybody. I see most people. I'm assuming that everybody is putting this information into your Cengage exercises. And at the end of class, you're going to hit the save and exit. Wow, there's a button there that says email instructor. That's brand new. Did you guys see that too? Wow, somebody should hit that. And so I can see what happens, because that has never been there before. And it just comes up with an email and you can just type in there. Okay. Somebody type in that box and then just hit send or whatever it says, because I'm just really curious. That must be new. Wow. I'm curious how I get those emails. That's kind of cool if you can email right from in there. But it's not cool if I don't get the emails. So you think you're asking a question, I'm ignoring you.
Get email like 10, 20 times.
Really? Okay, I'm just gonna check because I really have to find out where that comes from. Oh, but yeah, my AT&T phone, I have no signal here, so I'll let you know on Tuesday whether how I receive those, how I find them.
Or even if you get them.
Right. Because it's not cool if I don't get them. Go ahead and do part C on your own if you haven't. As I said, I hope everybody's doing these in Cengage so that you don't have to repeat them later. But if for some reason you're not in Cengage at the moment, I would recommend, making a note of what the answers are here so that when you get into Cengage later, you don't have to redo everything. Okay. Patty? Right, you can hit save and exit and it's just gonna dump you out, but you can, when you restart them from that menu where you have all the assignments listed, you can just restart it and everything you've already done is saved. Yep. Okay, so when you put those numbers in, I see some people have already done this. When you put numbers in, and you can hit, as I told you on Tuesday, you have unlimited use of that check my work button. So whether we're working on it in class or you're working on it on your own for whatever reason, you can always check your work. You can do that as many times as you want. And when you check your work, you get this feedback box. Remember on Tuesday, I showed you that it wasn't showing anything other than your answer is incorrect. But usually you get something like this that gives you a hint of what to do. It reminds us of the fundamental accounting equation and that you can rearrange it using what you know about math to be able to solve for that missing piece. Everybody good with that? You got the basic assets equals liabilities plus equity. You know what each one of those three terms means. Cool. Okay. Let me go back to my PowerPoint for a moment. And with the last remaining time we have here, I want to talk about the 4 basic financial statements. So I already mentioned that every publicly traded company has to, on an annual basis, prepare their financial statements along with the accompanying notes, and that makes up their annual report. So the company that you're choosing for your project, they have an annual report that will have ended sometime in the last 15 months. The most recent one should not be from 2017. It should be from 2021 or even 2022 at this point, if their fiscal year ended like in January, February, March, maybe even April at this point. It does take 2 or 3 months after the close of their fiscal year to have those financial statements prepared, audited, and then published. But you absolutely should be able to find a financial statement that ends in 2021 at the oldest. Anything prior to 2021 is too old. Okay. So for financial statements, this is what this is the focus of our class this whole semester, is preparing these four. They're, as you can see in this slide, they're prepared in the order you see here. We do the income statement first. The income statement says, here's how much money we made this year, basically. It shows our revenues. That's one of those terms that I skipped over earlier in the PowerPoint. The revenue represents, in simple terms, the amount we charged our customers for whatever we sold them, the product or service that we sold to them. Expenses are the costs of earning those revenues. Now we'll dig more into what exactly is an expense when we get to chapter 3 in a couple weeks. But expenses are the costs of generating those revenues, and the revenues represent basically the sales to our customers. So the income statement is, in simple terms, revenues minus expenses equals income. Now this book, for some reason, likes the term profit. We don't usually in accounting use the term profit. They love it in this book. So you'll hear me talk about income, and that means what's left of your revenues after you pay the expenses. We do that first. Next, we do the statement of stockholders' equity, which shows, we already talked about what equity is. It represents the ownership stake of the stockholders in that company. And so the statement of stockholders' equity shows, here's what we had at the beginning of the year. Here's what changes happened to it. We made some money, maybe we paid some dividends, and here's how much we have at the end. That's simple terms. Next, we prepare the balance sheet. The balance sheet really is that fundamental accounting equation given detail. So it's assets on one side, we list them, how much each one of them is worth. So cash, $14, accounts receivable, $27, supplies, inventory, equipment, buildings, land, all that stuff that we own, how much is each one of those worth using the historical cost principle. And then here's our total. And then on the other side, we have our liabilities. We list and total those as well. Who do we owe money to? How much do we owe them? And then in total, and then our equity. Here's our stock, which represents the amount that we sold that stock for originally. And then we have what's called retained earnings, which represents the amounts that the company has made in all the time that company's been in existence, minus any dividends that have been paid out. So the balance sheet looks like the fundamental accounting equation, and we can see at the bottom, yep, our assets do equal in total our liabilities and equity. Last one on this list is the statement of cash flows. This is the one that we will spend the least amount of time throughout most of the semester. So I'm mentioning it now. I might mention it a couple more times. And then in chapter 13, which will be like November, I said April earlier, got confused about what semester it was apparently. In like November, we'll be covering chapter 13, and that's all about the statement of cash flows. But the reason that one comes last is because you have to pull information from the first three in order to do that statement of cash flows. So here, if I can get this to change pages. Here's a very quick example of what those financial statements look like. So the first box there is the income statement. You'll notice all of these financial statements have a 3-line heading. And that's the proper format for any financial statement. The name of the company is on the first line. The second line is the name of the financial statement or report that you're preparing. And the third line is what date does this cover? So the income statement talks about what happened during a specific time period. So its line says for the month ended, and we need to know it's for the month, not the quarter, not the year, not the week, not the day. It has to specify which time period. We then go down to the statement of stockholders' equity, and you'll notice the income here, the $3,050 that the company made this period. So we can see right here, the $3,050 the company made then comes down here to the statement of stockholders' equity and gets added to the company's equity. We had to do the income statement first to know how much money they made so that we can plug that into their equity. Next, the equity statement starts with where were we at the beginning of the period, so the beginning of the month in this case, all the changes that happened, and here's where we were at the end of the month on that bottom line. We need to do that before the balance sheet because when we come over to the balance sheet, those numbers from the statement of stockholders' equity land on the balance sheet. Okay, they're right here. And then, as I said, information from all three of those other statements lands on the cash flow statement. So we have to know and understand those first three financial statements before we can even think about understanding what's on the fourth one and how to produce one anyway. So it is very close to the end of our class period. So I'm going to stop here. Does anyone have any questions about anything we've talked about? Anything at this point? Anything we talked about on Tuesday from the syllabus? Anything? It doesn't matter to me when you do them, as long as you do them before you submit them for grading. One you definitely can do. 7, maybe you can do it because I did talk about the balance sheet or talk about the financial statements. But if you didn't hear the question, it was those 3 that are independent. Do you need to do those like today or before next class? And you do them whenever you're ready to do them. Certainly you can look at them. If you don't have a lot else going on right now, feel free to do them. I won't be looking at them until after the whole thing is due. Okay. Thanks for being here. See y'all on Tuesday.